Joining us now to talk about South Africa's foreign direct investment flows, also known as FDI, is John Bellew, who is partner and co-head of Webber Wentzel's private equity division. Morning to you, John.
Morning, David.
I've been reading a little bit about this before talking, and it seems to me there's a comparison with the private or residential housing market. There's a group of people who qualify for government grants, and then you're too wealthy, as it were, too well off to qualify, but you're not well off enough to buy a house of your own. So there's no man's land in between. Now, we as a country seem to be like that with FDI. We're too rich to qualify for development finance, like some of the poorer countries, but we're not attracting the investment that we should.
I think there's a certain amount of truth in that. I think certainly in the private equity space, South Africa is now too developed to really be on the radar screens of many of the foreign direct investors in the DFI space. So what we see is a lot of first-time fund managers who have more of a pan-African mandate, particularly in focused niches, being able to attract DFI money. South African funds with more of a South African base are having to work harder for their money because that DFI money is not really accessible to them.
I love these abbreviations. It's the same letters. DFI is Development Finance Investment, and FDI, which is rearranged, is Foreign Direct. Just give us the context of how much money are we talking about here, and the movements of that money in and out.
We're talking quite a lot of money which has been raised, particularly in the private equity space over the last 5 years. It's good foreign investment because that money, when it's ultimately deployed, gets deployed for a much longer term than money gets deployed in the markets. So, and it's getting deployed into companies that are growing, that are creating jobs, and very often that are delivering very good BEE as well. So it's very positive FDI.
And that's as opposed to money in portfolios, investment, which can come out literally in hours or minutes when people want to sell or buy. This is money that you're saying is actually invested in real companies.
Your typical private equity fund will require a commitment from its investors for 5 years. And that money can be drawn down any time within the 5-year period. And typically it will stay there for, in any investment, between 3 and 7 years. So in that period, your private equity investor will look to exit, and he will hopefully look to leave behind a much better company at the end of the day. So
how should we be thinking about this? All is not as it seems.
I think that the private equity foreign direct investment is fairly invisible. I think that S.Africa, which is the industry body for private equity, is starting to do a great job about building the public profile of private equity, speaking about what is actually being achieved in companies that are owned by private equity investors. But up until now, no one has really noticed these capital inflows that have come in under the radar and stayed here for a considerable period of time.
But they are by definition private, so a lot of them don't want to be on the radar, do they?
No, look, they don't want to be on the radar in many senses, but a key aspect of your business in the private equity space is building a track record, because it's your track record that enables you to raise successor funds and to raise more capital. And so you do need an element of publicity about the good work that you're doing. So whilst the contractual arrangements between the funds and their investors are certainly private, I think worldwide there is a set of fairly common international terms. I think in the local market people are starting to understand the asset class. I think there could be more investors looking to invest in the asset class, but those who have done over the last 20 years have done very well. Why
are we getting less than we might get?
I think that when I say we're getting less than we might get, the market is still very healthy, and the funds that are well established in our market are raising capital. It's taking longer, but that's really a function of the world economy and the global financial crisis, which left a lot of traditional private equity investors overexposed to the asset class. What we're seeing now, I think, is really the Africa story as a whole coming to fruition. People looking for yield all over the world, looking for yield in Africa, and that includes in the private equity space. So a lot of the work that we're doing at the moment is for funds whose geographic mandate is much broader than just South Africa, and investors seem to want that diversity.
I was going to say, you know, you're an expert in this field. You work for Webber Wentzel, and that's what you do. What occupies your time most? What are the big issues that you have to advise on and facilitate on?
Well, I think that one of the big issues for us as South African advisors is this, obviously we would like to see South Africa being the gateway into Africa for private equity funds. So we preoccupied quite a lot with policy. We interact a lot with government to try and make the environment for private equity better, and that's both in relation to tax. It encompasses the whole exchange control environment. In recent times it's encompassed changes to pension fund legislation to enable pension funds to invest in private equity more easily. So there's quite a lot of lobbying and regulatory change and frankly education that happens.
Sounds like there are quite a few issues too. So how friendly are we? I mean, are there quite a lot of changes that you would like to see? You know,
I think that historically private equity had a bad rap, and that came out of the way that private equity happens overseas.
And I think the reason there is that huge amounts of money coming in and out, but no accountability on the people moving it around.
Well, I think the traditional view of private equity was very much the barbarian at the gate. You know, come in, strip the assets, fire the staff, leverage it, you know, very highly, and therefore strip the tax base. And that really hasn't been the pattern in South Africa. South African private equity has been much more modestly leveraged, although obviously leverage is key. And DBSA actually produces a survey every few years that shows how private equity owned companies perform in relation to stock exchange owned companies. Generally they provide better returns, they create more jobs, they introduce more products, and they end up better off at the end of the day. So private equity in our market has been a very, very positive factor for social good. And it's taken time to really get that message across to government and to the regulators. And that's probably been 5 or 6 years doing that.
In South Africa we have all these associations and representative bodies and so on. Is there a spokes body for private equity?
There is. There's an industry body. It's called S.Africa, the South African Private Equity and Venture Capital Association. It's very active and proactive. It lobbies a lot on behalf of the industry across a broad spectrum. And a number of firms, you know, provide support to S.Africa in its lobbying efforts.
Perhaps because of the name, and I think of it as Venture Capital Association, not private equity.
Yeah, it is strange. Worldwide, that seems to be the way in which these entities name themselves. But mainly, you know, venture capital in South Africa is very underserviced, and the private equity market is fairly well developed.